Alrighty, guys. Here begins chapter 3. I'm going to go ahead and probably have this in 3 parts because it's a lot. We're talking about now the accounting cycle. We're talking about everything that gets done, all right, that we're going to be doing. So we're going to be doing with the beginning with the accounting cycle, which is going to be the normal procedures over a period of time. It usually takes 1 calendar year, usually from January 1st to December 31st. Like say 2019, we just began up until the 31st. That's a calendar year because it follows the calendar. Fiscal year is any 12 months consecutively. The excuse me, the how would I say? The company could have started in, let's say, August. Okay, so if it starts in August, then it would go until the following year, not August, but the year before, which would be July, so that you could count on and making sure that you've got the 12 months. Okay. So again, you can have either the accounting period be monthly, quarterly, or annually. And typically in accounting, you're going to have both monthly, quarterly, and annually. And that's called a natural business year, usually. The general journal, okay, this is where you're going to put in every transaction for everything that happens. If you pay an expense, if you get money in, it all gets recorded into this general journal. It's the simplest form. It's a journal because it's like a diary in a sense of all of the transactions that are going over that are located in the same place. And the information is in chronological order. What happened today? What happened tomorrow? What we did. And the relationship between the general journal and the chart of accounts is this. You're going to show that, okay, I received cash. Okay, I received cash. Let's say it was $200. And so I received cash because it was for revenue. So you would debit your cash, debit your revenue, debit your cash, then credit your revenue. Both are increasing of the amount of money that you've got. Okay, and again, as I was confused there a little bit, you have to remember which one am I going to debit first and then credit. And again, go back if you need to in chapter 2, I think it's page 36 or 32 to determine what the normal balances are of each one of these chart of accounts. The formalities are that you're going to have, again, the debit portion is always recorded first, then the credit. Then underneath it is an explanation of what this happened. Where did I get this money from? You just can't say that you got money. You have to show where you got it from. Usually it's one line. You put a space in between each line to make it easier to read. And the total amounts of the debits should equal the total amount of the credits. And every transaction does continue to affect 2 accounts. Okay? At least 2. So for example, is what we're talking about. So here we go. May 1st, Mel Blast began the business by investing $10,000 in cash. This is your general journal. So what you would do is you would record cash, $10,000, then Mel Blast capital account, debited, credited, because that's the normal balance of each. Both are increasing. And then here is where you put your explanation. You also put the day of the month, the year, and the day of what's happening. Okay? It's pretty simple. So then you see again where he's purchased computer equipment. Notice for $1,000. So, and promising to pay the balance within 30 days. Okay, so here, you're still going to go ahead and put in the information. All right, so you're going to go ahead and put in the funds of the fact that this is a compound entry where 2 or more, which is 3 actually, are being used accounts. He's going to pay $1,000 right now, and then he's going to pay the balance within 30 days. So you debit the computer equipment for the entire $6,000, increasing your asset. But notice you then credit your cash for $1,000, and then you put the rest of it, of the $5,000, in accounts payable, showing that you purchased this. This still is $6,000. This is $6,000. This is a compounded entry. Another one, rented office space. Paying, now you're paying in advance. Paying this information is called prepaid rent. It would be considered an asset because you've got all of this amount of money that you're prepaying in advance. Later on, you'll see how we expense it out. So you see how I prepaid rent, gave them additional money. So I debited the $1,200. And then I put in where I credited cash, decreasing my cash account. And then I paid the rent. But I go ahead and show that here is 3 months. So each month, if you divide 12 by 3, it's what? $400. So we're going to see in the future how we're going to be dealing with this prepaid rent. Supplies on account, simple. Debit supplies, then you credit accounts payable, and you go ahead and you show. Now notice, I purchased some computer supplies from Norris. Here's where you're actually detailing which company you used it from. Again, completed computer repairs for a client and immediately collected $3,000. So again, immediately collected. So you would go ahead and debit your cash account and then credit your computer fees. It's revenue that came in. And notice what it says, cash received for services rendered. Paid office salaries. Again, you would debit your office salaries. You would go ahead and credit your cash, decreasing the amount. And again, showing what you did. You paid office salaries. And notice, here I'm just putting in the dates because the month hasn't changed. Paying your advertising bill, but not paid. Okay, so again, advertising bill, debited, accounts payable. Bill but not paid from Al's News. Here again, showing who you owe. Okay, then Mel Bass wrote a check on the account of business to pay his home mortgage. Notice, he wrote a check on the bank account of the business to pay his home mortgage. His is a clue here. It's personal. So notice, you go ahead and you show your withdrawals of $625. Debited, credited cash, personal withdrawal of cash. Okay? Another one. To complete a repair of all its computers. So accounts receivable, $5,000. Got the money in. Computer repair fees is credited. He paid off his salaries again. So now you're putting in the amount of money that he paid in for office salaries expense. Cash is decreased. Paid half of the amount for computer equipment purchased from May 1st to Ben. Okay, so from that $5,000, he paid half. So accounts payable is debited, decreasing the amount, and then a cash is credited as well, decreasing the amount of money that we have in cash. And again, he goes ahead and he says what he did. Received and paid telephone bill. So, received the bill, telephone expense, debited, cash, credited, paid it, recorded. Now we go ahead and from this journal, we're now taking it over to the ledger. Okay? The ledger involves the transfer of the information from the general journal. In the debit account of the ledger, record the date again, then record the page number of the journal. If you only have one page, you refer to it as General Journal 1, page 1. The reason that you want to go ahead and record the page number is so that you're not having to flip later on if you need to find something. You know exactly where it's from. Calculate the new balance on the account and record. So here we're going from all of the information recorded in the journal, the monthly postings, into a ledger. The ledger is detailed and it's just for that one account. Okay? And of course, you can show if you record the number of the debit on the posting reference column, it's called the listing, the cross-referencing. We don't have to worry about that right now. So this is what we're doing. So here, this is the first investment. So page 1, post right here, Journal 1, okay? That's your post reference. So you're putting it there, and then you're putting in May 1 here, The explanation is here as well of what we're doing. We're taking in the, you can say, cash, but this is also just for the repair service. So you're showing of how this is now cash, county number 11, starting up the business, $10,000 in the debit amount right here. And then you're showing then the balance here as well. It's almost like a checkbook, but some of you don't work with checkbooks. It's okay. The second portion of that transaction goes into capital here, account number 3100. So now we're going and showing where posting back on page 1 of the general journal, and you're putting in then again May 1st explanation, capital for the investment by the owner, and you're putting in the credit here because it increases, and then you're showing the balance of the increase of the first transaction. Okay, so on the trial balance is what we're going to start next.